Yeah, welcome back to business taxation. And after we have spoken about the corporation tax system in general, we can now have a closer look to corporation tax system problems which result in cross-border situations. So especially there where we in our study program have a focus on. Yeah, so we have up to now left out a very typical element of the taxation of profit distribution in most countries. That is a withholding tax on dividends or in general on capital income. You know that, for example, in cases where you get paid a salary or a wage by your employer is obliged by law to keep back, to withhold a part of your salary as tax and transfer that as a prepayment for your personal income tax to the fiscal office. Well, and exactly the same principle applies very often in most states of the earth when dividends are paid out. The idea is probably also the recipient of a dividend might forget to declare it or might spend the money completely before the state can obtain its share, its tax. And so companies which pay out dividends are usually obliged to take such withholding tax from the dividend amount, transfer it to the fiscal office, and only give you the rest. So that is in most states the case. So one part goes as a prepayment for your personal income tax to the fiscal office. That is the withholding tax, because that amount of money is withheld from you for tax purposes. And only the remaining net amount goes to your bank account. So basically, the company pays on two different bank accounts of yours. One, the tax amount is paid into your personal, let's call it bank account with the fiscal authorities, and the remaining amount goes to you personally in your bank account. Well, now in Germany, we also have that. And as I already said, most states know such a thing. In Germany, that withholding tax is called capital income tax, Kapitalertragssteuer. And you find the rules in the paragraphs 43 and 43a of the Income Tax Act, because you know all the rules which apply to every legal form of recipient to natural and juridical persons is usually to be found in the Income Tax Act, whereas the Corporation Tax Act contains these additional rules which only apply to juridical persons. Well, that Kapitalertragssteuer, that capital income tax, or that withholding tax on capital income amounts to 25% of the gross payment at the moment in Germany. At the moment, by the way, if you watch the video later, at the moment means 2021. Well, 25% of the gross payment, paragraph 43, 1, so section 1, number 1 says dividends are subjected to that capital income tax. And 43A1, number 1, states that this is, in this case, 25% of the gross amount. Okay, that's probably still easy. Now, this withholding tax is a prepayment on your final income tax. So usually at the end of the year, when you make your tax assessment, or no, when you make your tax declaration, and the fiscal office makes your tax assessment based on your declaration, then the final income tax will be determined. And then if you have overpaid, the overpaid amount will usually be refunded. If you have not yet paid the full amount, the remaining amount will be claimed in addition. At the moment in Germany, the situation is far less complicated, because since the reform of 2009, when a separate tax rule for capital income was introduced, the regular tax rate for capital income is 25%, so that the final tax rate, 25%, and the prepayment rate, 25%, all base are identical, with the consequence that German law permits you to officially and legally forget things like dividend income when you hand in your personal income tax declaration. But in all cases where such revenue is not collected under the headline income from capital, but as income from business, or where you are not subject to income tax but to corporation tax, in all these cases where the 25% flat rate rule does not apply, in all these cases you will be assessed with that income, and the 25% withholding tax will be regarded as a personal prepayment, which is credited and, well, depending on the situation, even refunded to you. So that makes life easy. So when you have a group of enterprises, so that a parent company receives dividend from a subsidiary, in a system like ours here, dividend exemption system, then you have a very characteristic situation, because when the profit is made, the corporation tax is paid by the company, which earns the profit. Corporation tax remains definitive. You don't get anything back. But then at the time when the dividend is paid out, you will have, or not you, but the company withholds the withholding tax. Well, let's say it's 80 what is left over from 100, so 1/4 of it, 25%, goes to the fiscal office, only the rest goes to your bank account. Now, the parent company will later be regularly assessed with the dividend income. And now let's have a look on that assessment. The gross dividend amount will be 80, because, as in the case of the wage tax, that withholding tax is a prepayment made to your personal bank account, the fiscal authorities. It lowers your fiscal liabilities, or it can even be obtained back, so it's a financial advantage, so it's a revenue. So the total revenue from the dividend is first the cash amount, 60, plus the withholding tax amount, 20. Now the tax due on that amount is, if you hold a major participation, a simple 0 under 8b1 KSTG. Now the final assessment is nice. You owe the state a 0 amount, you have prepaid 20, so you will get a refund of 20. So the withholding tax is absolutely without long-term consequences. It was just a small impact on your liquidity for several months between dividend payment and refund, but it does not really matter. So no drastic economic consequences. The only tax which matters in the end is the corporation tax of the subsidiary. All the rest is silence and is only temporary. You remember there was also another alternative. If a state says we don't exempt the dividend on the level of the parent company, then we grant an indirect tax credit. But then the situation, the effect of the withholding tax is overall similar in an inland situation. You begin again with the corporation tax paid by the subsidiary. Let's say again subsidiary earned 120%. That's rather arbitrary. We needed a percentage. So let's say 20% go to the state as corporation tax. Then we decide to pay out the dividend. We have an amount which we can pay out of 80. 25% shall again be the withholding tax, now in our state with that indirect tax credit system. So withholding tax 20 goes to the state and 60 goes to parent company's bank account. Now, next step. The parent company at the end of the year has to be regularly assessed. Now, the assessment looks as follows. We have a gross amount of the dividend, again of 80, because 60 you got in cash and 20 was the withholding tax, which is a payment in your name on your account for the fiscal authorities. So it's revenue, although you don't get it in hand. Well, then you also get the indirect tax credit for the underlying tax of the subsidiary. That was 20 in our case, and so we end up with a total taxable dividend revenue of 100. Now we apply the tax rate of the parent company on that. Let's assume the parent company has the same tax rate as the subsidiary, because both are in the same state, and so it's a reasonable assumption that they both have to pay the same tax rate. So we have 20%, we owe 20. Now we can offset the tax credit against that, that's 20, and we have a withholding tax prepayment, which might even be refundable. So we get a refund of -20 because all our prepayments and credits amount to 40 and our obligation is only 20, so 20 come back. So also here, the withholding tax will have no big consequences in the inland situation. Now let's have a look to the same thing in a cross-border situation. The 3 steps again: corporation tax by subsidiary, withholding tax, corporation tax assessment by parent company. Well, we have in principle the same 3 steps. So let's have a look. But now 2 countries are involved, the country of the company and the country of the shareholder, that is of the parent company. Well, let's make a bit of fun. The tax rates are probably not entirely identical, so 20% versus 15% or so. Why not? So when the profit is made, the subsidiary pays corporation tax. We are used to that. That doesn't change. That's nice. Everything plain and simple. Now the dividend is paid out, so the state of the company takes withholding tax, 20 again, because we wanted it to be 20. You could also choose every other number. And now, well, these 20 go to the state and the 60 go to the bank account of the parent company in that other state. Net amount of the dividend arrives there, 60. Well, they also got 20 in form of additional revenue, because always the gross amount counts. So the regular assessment will be dividend revenue 80. Tax, which is due in a dividend exemption system, is 0. Now, prepaid but to a foreign state and therefore not refundable in the state of the parent company is 20. They will not refund that. So, unfortunately, in the state where the money comes from, in the state of the subsidiary, there the parent company is subject to limited tax liability. And now many states, Germany, for example, also does it, practice a system where a withholding tax paid out to a limited tax liability taxpayer is definitive. It's regarded as, for reasons of simplification, definitive. You don't get it back, you don't have to pay anything on top. Well, the tax was taken, it's never given back, no assessment possible in that other state, so that's it. So the 20 there, you don't get them back, and you don't get them back in the country of the parent company. So here we have now an additional financial burden, which you can't find in the inland case. In my example, it ended up with additional 20 euro for a cross-border investment in that group. If you have an indirect tax credit system, you have a similar situation. Although the animation here is a bit of chaos, you will see it's a similar situation. First, the subsidiary pays corporation tax, 20. Then 20, the dividend is paid out, and we have again a withholding tax, 20 go to the fisc of the country where the money was earned. And the rest goes again to the parent company, to its bank account, and now the parent company is assessed again. And now the dividend gross is 80, and they get the indirect tax credit, that 20 for the for the corporation tax of the subsidiary on top. Original profit, so gross revenue here 100. Tax, which would be due 25%. I just assume now 25% to have a bit of fun. So we owe our state 25%. First, we can use the indirect tax credit, so only 5 remain, but we can also, usually under a double taxation treaty or under unilateral rules for application of the credit method, we can usually credit the tax which we ourselves paid in another state, that is 20. So that's far more than enough, but the problem is the exceeding amount of 15 is not refundable. So again, we have an additional tax burden of 15, which we would have never had if we had invented in our own state. And now, surprise, again, in this situation, typically, these additional amounts can also not be recovered from the state where the dividend comes from, because there our parent company is subjected with the dividend to limited tax liability, and in all probability the tax there will be definitive. So that's a specific problem in a cross-border situation. So in the cross-border situation, the withholding tax often changes its character from a simple prepayment to an effective extra burden which would not exist in an England case. Especially, the consequences are really drastic when the foreign recipient is a parent company, because, well, if you have a look to the alternative constellation, a dividend goes to a natural person, then that's all not so important, because in case of a natural person, you make a profit, dividend is distributed, 20%, and then the shareholder will be assessed dividend gross revenue 80, personal income tax. Let's say the shareholder is taxed with 40% in such a foreign state or so. Then he owes his fiscal authorities 32. Prepaid was 20, remaining amount 12. Total tax for the dividend is 20 plus 12 is 32. So it's the same total amount as in that shareholder's inland situation. And so it doesn't really bother, it doesn't really matter that the tax cannot be recovered. The inland constellation and the cross-border situation is in that situation not worse, or not different, because the natural person as a shareholder pays such a high tax that all the taxes which are creditable can be credited. So we do not end up with an extra burden. But in that parent subsidiary constellation, we very, very often have that situation. We can nearly expect it due to the rules which want to avoid an economic double taxation with twice corporation tax in a group. So this specific situation is the reason why virtually all double taxation treaties have rules on limiting withholding taxes on dividends, but that these withholding taxes then usually have different limits for parent companies and for others, especially for natural persons as shareholders. As you probably know, already know, or will get known in the future when you occupy yourselves a bit more with double taxation treaties, you will there find different limits for withholding taxes in the draft of the Model Convention issued by the OECD. For dividends paid out to parent companies, they say the limit for withholding taxes should be 5% at maximum. And for others, 15% are regarded as tolerable limit. And this split is only explicable due to the completely different economic background. In the relationship between a subsidiary and a parent, even a small withholding tax can constitute a high additional total effective additional burden, whereas if a payment goes to a natural person, the withholding tax can usually be fully credited, so that one doesn't need to be too worried about its amount. In general, by the way, when you have such a limit in a double taxation treaty that the withholding tax cannot exceed or may not exceed, must not exceed 5% or 15%, the technique how that limit can be realized is then usually left to the states involved. There, the OECD and even the treaty does not interfere. For example, in Germany, they have a kind of a ping-pong procedure. Here, usually, that is here the second bullet point, usually the company is obliged to collect the withholding tax at the full regular rate, that would be 25%, then hand over to the dividend recipient an attestation which confirms we took 25% on the following amount, we paid it over on your account of the following fiscal authority, and then the dividend recipient can approach the German Central Federal Authority for Tax, the so-called Bundeszentrale für Steuern, present that attestation, present proofs that he, she, or it is entitled to a reduction under the double taxation treaty with its residence country, and then the fiscal authorities make a refund. Okay, we took 25, you only have to pay 5, so give us your bank account, here is the difference, here is 20% back. Or if the limit was 15%, here is 10% back. It is even possible that the other alternative, that the 5 or 15% or 3% or whatever is written in the DTT, can directly and immediately be applied by the company, but that is only allowed if the recipient, or on behalf of the recipient, the company, has applied beforehand to the fiscal authorities, to the Bundeszentrale für Steuer, to certify that this particular recipient of a payment can be partially freed of the regular withholding tax. So you get a certificate which says dividend payments to be made to Mr. Smith in New York, identified blah blah by the following characteristics, can be made until at latest, let's say a given date in 2 years or so, with a rate of only 5% or 15%, because we, the central authority, have checked Mr. Smith is entitled under the double taxation treaty. What he says is no lie. So the company is allowed to directly apply a reduced rate. But by the way, that's important, if that certificate from the central authority is not present, you are always bound to take the full withholding rate, and then the limit by the limitation which is relevant under the double taxation treaty is then reached by a refund. By the way, that this technique is either a ping-pong technique with we take everything and then give a refund, or by a certificate and so on. That is the reason why the OECD Model Convention, in connection with such a thing, very often states that blah blah, here are certain limits, and the way how the limit is realized in reality, that is a matter for the competent authorities. They shall agree on the procedure. That is nothing else than the permission that it's absolutely okay to take 25 and refund 20 instead of directly apply only 5%, which might be too complicated for the average accountant of a company. Well, that said, let's go back to the problem. In cross-border situations, in a group between a subsidiary and a parent company, that withholding tax can easily turn into an additional effective fiscal burden, which you do not have in an inland situation. And now, well, this creates a specific legal problem within the EU. Because in the EU, you know, there is a single market, there shall be no interior or internal borders for the economy, and especially the single market grants the enterprises the freedom of establishment. And the freedom of establishment means that any enterprise of a member state can found an agency, a branch, or even a subsidiary in any other member state without being hindered or discriminated on the grounds of doing that. So we have now just seen in the last 20 minutes that if a company sets up a subsidiary in its own state, the withholding tax has no bad effect. But if it sets up a subsidiary in another state, the withholding tax comes and says, hey, here I am an additional fiscal burden for you. And that effect leads to automatically to the conclusion that the tax system which exists leads to worse economic conditions for cross-border activities than for inland activities of a group of enterprises, and that is exactly what the freedom of establishment wants to abolish. So the European Union saw the need to do something here because the treaty on the EU says, or the treaties say, that the freedom of establishment is granted and that obstacles for it shall be removed either by the member states, or if they cannot achieve the removal of obstacles alone, by a central rule or directive issued by the EU, which then coordinates the reaction of the member states in order that the problem can vanish. And yeah, that is why the EU issued a Parent-Subsidiary Directive, which addresses this problem of the potential economic double taxation in a group, and also the problem of the withholding tax in a case of a cross-border dividend payment. Naturally, it only concentrated on cross-border payments between a parent company and a subsidiary company, because only in that constellation the withholding tax really poses a brutal problem. You have already seen together with me just 10 minutes ago that when a dividend is paid out to a natural person, to a partnership or so in another state, that then we do not have such a grave economic problem with the withholding tax. That is the reason why that Parent-Subsidiary Directive restricts itself to the relation to dividend payments between subsidiary companies and parent companies within the EU. So this Parent-Subsidiary Directive is a core regime for enterprises in the EU, so you must absolutely know it when you deal with cross-border investment. So you can't ignore it. So to give you the opportunity to look it up, here is a link, and I will also place the link in the description below the YouTube video, so then you can click on it and find the consolidated text of the directive. Well, that directive has a long history. The first draft was proposed in the 1960s, in 1969 to be precise. Then long debates happened, and when the single market project was under construction or on the way in from 1985 onwards, the fiscal minister said, well, we should also contribute a bit, and agreed politically to agree on that directive and to get it finished finally. So in 1990, together with the mergers and the merger directive of the EU, the Parent-Subsidiary Directive was agreed upon by the Council of Ministers. It entered into force on the 1st of January 1992. And in 2003 and a bit later also, several amendments was made. The most important one was in 2003, where under the Italian presidency, the necessary participation to be seen as a subsidiary was gradually lowered from 25 to only 10%. In 2009 or 11, oh, I'm not so real, 2011, sorry, here's a printing mistake. A new updated version was published where all the changes in the meantime had been introduced into the text again, so a consolidated new text was published. Yeah, so let's change that. So it was 2011. Okay, so let's look to the main principles. The main principles of that directive were: first, it's natural that the country of the subsidiary takes corporation tax. Nobody debates that. That should not be changed. So the first step will remain completely unaffected. Where the subsidiary earns the profit, there the country takes the money. That is not even explicitly stated. So the subsidiary directive, or parent-subsidiary directive, sorry, mainly focuses on the treatment of the dividend payment to the parent. The first important statement is that an economic double taxation with corporation tax shall be avoided under all circumstances. So this means that the country of the parent has either to grant a dividend exemption or to grant an indirect tax credit for the taxes paid below by the subsidiary. And as that withholding tax problem exists, a withholding tax would lead to additional fiscal burdens. So the solution was simple. Any withholding tax on cross-border dividends paid between an EU subsidiary company and an EU parent company is forbidden by that directive. And that's naturally highly important. You will often meet the situation that in a double taxation treaty between two member states, there is still a clause like in the OECD-Model Convention that, for example, a dividend payment from the subsidiary or from a company in one state to a parent company in the other state can be taxed with, let's say, 5%. However, EU law precludes or forbids that the member states can make use of that permission under the treaty. That is not even a genuine legal conflict, because the DTT says the states can take a withholding tax up to 5%, and EU law says, well, the maximum tax rate for withholding tax is 0%. Stick to it. And so this is not even a violation of what the DTT allows. And by the way, even if there were a direct conflict so that the DTT would say you must take a withholding tax of 5%, EU law said you must not, then EU law would always prevail, because, you know, EU law prevails over any other national law, even that is explicitly stated in the EU treaties. Even any other treaty between all other EU member states, as specific, however, has always to stand back in a conflict with the EU rules. Okay, so let's have a closer look to the Parent-Subsidiary Directive. The first important step is this directive is only applicable if the company and the parent company involved are both companies of a member state. So the Parent-Subsidiary Directive directly steps down and says, okay, I'm out and gone. If there is a dividend which a German GmbH pays to, let's say, a permanent establishment of a US corporation in another member state, because then the parent company is not a company of a member state. So the directive clarifies what is meant by companies of a member state. It must be a company which is founded, so registered in one of the member states. It must be a corporation according to a list. Every member state had to hand in a list of the juridical persons which they wanted to qualify for the Parent-Subsidiary Directive. And so there is an annex to the directive. And if you are on the list with your legal form, you're lucky. And if not, then you're not. It has already been There have already been cases where a certain institution had a subsidiary in another member state, wanted to get their dividends tax-free without withholding tax, and then detected their home state had not put them on the list. And then jurisdiction said, okay, here the directive is plain and clear, absolutely simple. If your legal form under which you are registered is not on the list, which has been presented by your home state, you are not entitled to benefits under the directive. So that can be rather ugly. Well, then you must also be seen as a taxpayer in a member state. So you need to be subjected to corporation tax. And, well, you can also be a taxpayer, but completely exempt. If that is the case, you are automatically excluded from the application of the Parent-Subsidiary Directive. And if you are only taxable on grounds of an option, so if you could choose if you wanted to be a taxpayer or not in your member state, then you are also out. Further, you must be regarded as the resident of a member state under the national law of that member state, so unlimited tax liable there. That's what is meant. And there shall be no rule which says under the rule of a double taxation treaty, one or two or how many, you are regarded as resident of a third state. That could happen, for example, if you are registered in, let's say, Germany with your registered office or your statutory seat, to express it in a way as Germans would express it, and you have your place of management, let's say, in the US, then you would, in all probability, under the DTT Germany USA, be resident in the US. And then the PSD says, the Parent-Subsidiary Directive says, okay, I'm gone. Which makes sense because under such a treaty, the dividend which goes to that parent company would then not be taxed in Germany but in the US. And so, as they wanted to establish that system only within the European market, it makes sense to exclude such double resident companies from the application of the directive. Well, so the basic rule is only cross-border dividend payments between companies which are founded in the EU are covered by the directive. To illustrate that, the PSD sees the following situations as cross-border. First, you have a subsidiary, you have a parent in the other state, and the dividend goes cross-border. Or you have a subsidiary company, you have a parent company, perhaps in your own state. That parent company has, however, a permanent establishment in the other state, and that permanent establishment holds the shares in the subsidiary. so that the dividends go cross-border. But what is not privileged would be you have a subsidiary company, you have a parent in another member state, and a permanent establishment in your own state, the state of the subsidiary. And now, surprise, the dividend goes to the permanent establishment. So the dividend is an inland payment. Why is in the last situation the directive not applied? Well, it's basically then a mere inland situation. Especially the permanent establishment will be assessed in the state of the subsidiary. So the withholding tax will be treated during that assessment as a regular prepayment. So the additional burden effect will vanish, and that explains why we only need to have a look on the first situations, the first two. Well, furthermore, parent and subsidiary requires that there is a certain intensity of the participation. So in the modern version, the current version, at least 10% shares must be held, 10% in the capital of the subsidiary. Now it could be that the one or other investor company says we hold only 9% or 8% in another company, but next month the dividend is due and we don't want to pay withholding tax. So clever as we are, we go to the stock exchange, buy additional 2% of the shares, hold them on the day when the dividend comes, and 2 days later we sell them again in the stock exchange. So with a bit of money we saved a bulk of withholding tax. So the member states can introduce into their national law a condition that the directive benefits are only granted if the participation is held for a longer time, and the directive says you can require a time of up to 2 years. Germany, for example, has made use of that option, but has said we grant the advantages of the directive if the participation is held at least over 1 year. And the directive also says that, well, 10% of the capital, if two states want to deviate from that, they can also make a bilateral agreement that they do not look to the percentage in the capital, but the percentage in the voting rights, if they regard that as more convincing. If such a bilateral agreement does not exist, that means by default then the percentage in the capital counts. But how is economic double taxation avoided by the directive? So what is the real material contents of the directive? The state of the parent company shall either grant an exemption from the dividend or grant an indirect tax credit for the corporation tax which has already been paid by the subsidiary or by subsidiaries of the subsidiary or subsidiaries of the subsidiaries of the subsidiaries, and so on, as long as each subsidiary in the chain qualifies as a subsidiary in the sense of the PSD. So even a subsidiary of a subsidiary also can, if they already paid, then the tax credit is always granted on higher levels. So you can't end up with the situation that if the dividend went over 3 or 4 levels, that then the tax credit is lost and the last recipient, the highest parent company, has then again to pay full tax. No, that's not the case. That risk doesn't exist. Now there has been entered an additional clause. It might be that the parent company state says we do not see the subsidiary as a corporation tax subject. From our perspective, it resembles more to a partnership, so we want to tax it in our tax system as a partnership. In that case, the directive says, okay, we, the directive, do not hinder you from seeing things this way. By the way, The directive doesn't say we allow you this, because if higher rules or other rules preclude, forbid, or make impossible such an attitude, the directive can't allow it, and so it's just say this directive doesn't hinder you to see it this way. But concerning other things, we remain silent. Okay. The state of the parent company, if they want to see the subsidiary from their perspective as a partnership, then they can do it, but then they also must avoid a double taxation either by exemption method or by the credit method. And naturally, if they say that this is to be seen, the foreign entity is to be seen as a partnership from their perspective, then there can be no dividends. So later they cannot pay asked tax on the dividends. That is in Article 4.2. And by the way, that is a bit strange because all the entities in the annex are entities which are juridical persons, and under the rules of the Treaty on the Functioning of the EU, so under the very basic rule of community law, every juridical person established in a member state has to be accepted as existing and to be accepted as a juridical person. So you will have to tax them as a juridical person, which nearly necessarily entails the consequence that you have to treat them as a corporation. So this 4.2 exception that the subsidiary could be seen as a partnership is nearly only possible if the subsidiary opted, or the parent opted, to have the subsidiary seen by its state as a partnership. So other possibilities are very, very rare. Another possibility, however, where that might come into play, Article 4.2, might be that it indirectly also legitimizes perhaps the controlled foreign company taxation if something exists, but that would be rather far-fetched. Okay, so the member states, you know, in a dividend exemption system, you remember that 5% lump sum rule, which said when you get a tax-free dividend, you can exclude the expense relating to the tax-free amount from deductibility. And the Parent-Subsidiary Directive says, okay, you can do that. You can exclude expense relating to the tax-free dividend or to the dividend from deduction. And if you want to do that in a rather rough way by an estimate, the maximum percentage which you can apply for the estimate is 5% of the dividend. That is the explanation why Germany takes 5%. Interestingly, the text does not restrict that a rule that you can exclude expense from deduction to the cases where the dividend is exempt. If you just look to the wording, even a state which grants an indirect tax credit could exclude expense relating to a dividend from a subsidiary from deductibility, which would be rather surprising. Good. Furthermore, withholding taxes are strictly forbidden. That applies to the state of the subsidiary and the state of the parent. And by the way, what I didn't really write down here on the slides up to now is all these rules only apply for current taxation if you have a liquidation in play. So when the subsidiary is bound up and everything is sold and then the property is distributed, then everything is different. Then the directive does not apply. So only current taxation, not liquidation, is privileged under the Parent-Subsidiary Directive. Well, then let's come to exceptions. Several member states originally practiced an imputation system. You remember that. And now the problem was if a withholding tax is forbidden. Now imagine somebody takes 50% corporation tax and is willing to hand that completely back in a cross-border case. And now imagine a withholding tax is completely forbidden. Then that would mean that perhaps the state of the parent company would end up with all the fiscal revenue. And that would not have been fitting. So there were, in Article 7, 2 exceptions formulated for cases of such an imputation system. At the moment, rather unimportant because these systems have strongly lost their importance. Furthermore, there is a general exception which says the directive is not applicable where we have to do with an arrangement which was mainly made in order to obtain the benefits from the directive, so which is not made due to genuine economic motives, where the main purpose is just to obtain the application of the directive. In such a case, the directive is not applicable. That means, plainly said, the directive does not apply in case of what we would call tax abuse. However, when that condition is fulfilled is now a question which must necessarily be decided by the European Court of Justice. So we have already jurisdiction what can be seen as a tax abuse under the criteria of the Parent-Subsidiary Directive and what can not be seen as such. A last question which we still have to comment is if the Parent-Subsidiary Directive rules can also be directly or indirectly be applied to other states. First, naturally, we have to ask ourselves what happens with regard to the states of the European Economic Area, that is Iceland, Liechtenstein, and Norway. And the answer here is the directives do not apply in these states because the EEA takes over all the EU law for the economy with some exceptions, and one of the explicit exceptions is the tax directives of EU law. So VAT law, but also the Parent-Subsidiary Directive do not apply to the EEA states. However, if somebody pays out a dividend from a German, French, or Irish subsidiary to a parent company in one of the EEA states, let's say Liechtenstein, then these dividends may only be taxed in a strict, harsher way than a dividend to another EU state if there is a compelling reason for that. If there is a difference in the situation or a compelling reason to make the difference. Otherwise, it would be a discrimination, and discriminations are forbidden by the freedom of establishment rule, which, surprise, also exists for the EEA states. There is already jurisdiction which confirms that. So if a dividend would be paid out from Germany to a parent company in Norway, which has a comparable legal form to a parent company of an EU member state, then taxing on this with the withholding tax would be forbidden. Yeah. Furthermore, one has also looked to that strange state in the middle of Europe, which does not constitute a member state of the EU, but has established a very, very thorough and comprehensive network of bilateral treaties with the EU, by which an enormous amount of EU law has been indirectly made applicable in the relationship to that state too, that is Switzerland. And Switzerland has, surprise, concluded in the year of 2003 a treaty on the exchange of information on financial assets or so with the EU, where they obliged their banks and other financial institutions to pass on information to the EU states on bank accounts and so on. And one of the conditions under which they were willing to do this was that the Parent-Subsidiary Directive is also applicable to cross-border payments between an EU company and a Swiss company. However, at that time, the participation needed was 25%, and even during later reforms of the treaty, the necessary threshold was not amended from 25% to lower 10%. You can look that up in Article 9 of the Swiss EU Fiscal Cooperation Convention. I call it this way. The important thing is you find it in the official journal of the EU, number 333, page 12 and the false following, from the 19th of December of 2015. And I gave you here the link where you can find it out. And I also will place the link in the description of the video. By the way, this convention is rather the first double taxation treaty, under the material aspect, the first double taxation treaty which the EU has ever concluded with a third state. Yeah, that shall be enough for today. Thanks for watching. It was rather a long video this time, but perhaps the next one will again become a shorter one. Thanks for watching. See you, I hope, soon back again here on the channel, and goodbye for today.